Welcome back to Rich Dad StockCast. I'm your host, Denney, and today we're talking about something that can radically change your financial life: cash flow. Most people want more money, more freedom, more security, but they're not measuring the numbers that actually drive those outcomes. In business, they're called KPIs, key performance indicators. And the truth is, your financial life has KPIs too. Today, we're breaking down the 6 numbers that determine your cash flow, and once you understand them, you can start changing them. Joining me today is Rich Dad expert Andy Tanner, who teaches investors how to track the numbers that actually matter. And before we dive in, go to stockcastbonus.com. Grab your free investing tools. If you want to start improving your financial results instead of guessing, that's where you start. Andy, welcome back.
Thanks so much, Del. Great topic. I think my business partner is the best KPI guy I've ever seen. I'm so fortunate to have him. And I'm always learning more about KPIs, but I'll tell you this: the most important financial statement in the world isn't, the United States that's in a mess, or a state or a school or a business. It's yours, because that's the one that determines your standard of living. So if you can draw performance indicators out of your financial statement each week or month, that's a way to move the needle as fast as any. This is a way to move your needle as fast as anything I could tell you.
And speaking of moving the needle, stockcastbonus.com, amazing resources that kind of parlays into what we're talking about today. What do our listeners receive when they go there?
Stockcastbonus.com is always a good place to go, but on this particular episode, it's really even more, because I'm going to take you through 6 key performance indicators. If we have time to do 6, I'd like to do 6. One of them is different than you'll think. One of them is a little different than you think it is. But I have an ebook at stockcastbonus.com that really expounds on this, and it is so actionable. It is, I believe that having a weekly meeting, or at least a monthly meeting, I do mine weekly, having a weekly meeting where you look at key performance indicators will move the needle faster in anything you're doing. So that's what stockcastbonus.com. And I've got a lot to say about that. So I'll probably be a little bit too verbose if you turn me loose too early on it.
All right. I love it. All right. So let's start here. Before we get into the actual 6 numbers, let's get some context behind that. So why does measuring the right numbers change financial outcomes?
Well, there's an old saying that says when performance is measured, performance improves. When performance is measured and accounted for, performance improves exponentially. I don't know if it improves exponentially. I mean, compounding is exponential. But there's also a saying that says what you focus on expands. So if I'm looking at my performance, it's almost guaranteed that my mind will begin to make adjustments, because attention shows that I care. Attention sparks creativity. Attention leads to action. There's an idea that says out of sight, out of mind. Well, if you don't have if you don't have a wealth mindset and you're not thinking about this, and it's out of mind, I tell my son that the most important skill you can have as a basketball player is focus, because it doesn't matter how athletic you are. If you're not focused on what your team's doing, what good is it, right? Effort. If you're not focused, your effort's in the wrong direction. So just the mere idea that you direct your attention as a regular habit on your finances and on your investing and on your financial goals weekly, that puts that at top of mind. And what you think about, you do. You don't do things you don't think about. So I'd say that it is the number one habit by far that if a person doesn't like where they are and wants to do better, either start looking at those every week or improve how you look at those every week.
And to take it a little bit further, why do small improvements in the right metrics create big results over time?
Well, 1% is enormous. You and I both know Jeff Chadwick, and he was speaking at. I was in San Diego watching him speak, and he talked about it, and he didn't even reference Warren Buffett. I don't even know if he knows Warren Buffett said it before he did. But he took us through some spreadsheets of his business, and he just showed that, he showed a handful of metrics. He said, let me just take one of these, improve it by 1%, and let's extrapolate that out 5 years. Now let's do it with 2 of them. Let's do it with 3. So, for example, if you were to take a 401k and take a 1% fee that Wall Street has and take it out of there and then look at the lifetime value of what would happen without that fee, just 1%, boom. Then if you wrote a covered call and got another percent, and I'm talking a year, you could do 1% a month is not unrealistic. It's enormous. So whenever you deal with compounding, 1% is absolutely, it's like Warren Buffett said, it is enormous. So that's how compounding works. And another way to look at this is, let's say you're in an airplane and you're at 12 o'clock and you say, well, I'll just go, 12:01 or 11:59. See how far on or off course and how different your course winds up with a slight course correction, a slight change in the angle. Look what that does to a roof. Look what it does to a hill. If you're biking and all of a sudden the grade goes up, well, you feel 1%. A 9% grade is palpable compared to an 8% grade, for sure, on a bike, for sure.
That is definitely true. And shout out to Jeff Chadwick. I can't help. I now think through Google spreadsheets because of him, and I probably will for the rest of my life.
Yeah, he's great.
He's amazing with that. Now, thinking about mindset a little bit, why should people start thinking about their finances like a business?
Well, business demands, as I said, attention, and business has what we call standard operating procedures. And the biggest thing, though, is you'll often have people say, look, it's not personal, it's a business decision. And what that means is that we're not emotionally invested. We're just going to do the right thing for those numbers. And when you treat it like a business, you remove the human element. It really is interesting to be an employee because employees have to do what their boss says, or they get fired and lose their income. They have to do it. So it doesn't matter if they feel like going to work or not. They have to go, or eventually they get replaced, right? It doesn't matter if they feel like doing a good job. If they don't, they get replaced. So the emotions of how they feel or how their family, the personal life goes home and it's just business. Well, if you can do that for yourself and put yourself first, pay yourself first and put yourself first and be unemotional about it, nothing wrong with a little passion, but being unemotional about it, you're going to make better decisions.
Very good. I do enjoy that opinion. I couldn't agree more. Let's do this. I want to dive deep into these 6 numbers, but let's take a quick break. Listener, if you want to change your financial life, you don't just work harder, you change the numbers that drive the outcome. And when we come back, Andy's going to break down those 6 numbers that determine your financial trajectory and how to improve them and how that increases your cash flow. And don't forget, go to stockcastbonus.com, download your free investing resources. That's where you start building financial clarity. Stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
All right, welcome back to Rich Dad StockCast. Andy, let's get practical. Let's walk through the 6 numbers people should understand if they want to improve their cash flow. So let's start with the first number. What should we track?
The biggest problem financially of life is the first number. That's the one we start with because it is the problem that you have, that I have, that my kids will have, that everyone listening has. And it's the problem of expenses, food, clothing, shelter, medicine, luxuries if you choose to invest in those. But there's a requirement to eat, and that some people solve that number by depending on their government. That's a horrible goal because that means I've absolutely relinquished my standard of living to someone else, and now the government will determine my fate. So that's one of the things I don't like about UBI. People love, UBI, free money. All that does is make everything more expensive because everyone has more money. We already have UBI. It's called Social Security. That's a universal basic income. It's just for older people. and it's supposed to give them that security, but it really is just above the poverty line, unfortunately. And so, that number of expenses, how are you going to solve that? Well, some people do it having the government help them. Other people do it by having a job. Other people do it by investing, right? Other people marry someone who will do it, right? I mean, there's all kinds of ways to solve that problem. I think investing, if most people could choose it and they had the education to do it, I think they choose passive income from assets to solve that problem. So as I look at my expenses, I have to ask, do I want my expenses over the next 10 years to go up or down? Now, Dave Ramsey's always going to say, take your expenses down. I say, I want them to go up. I want a plan that allows me to deal with inflation. I want a plan that allows me to get the best medical care. One of the things that we really care about in my family, it's interesting because, my son is having some great lessons away at college. And one of the comments, and he has a scholarship to play basketball, so he goes to the meal ticket and everything, and it's great food, but it's not like we have at home. It's not even close. So we really care about the quality of our life, and we see that through the lens of expenses. So if I want my quality of life to improve, I don't want or need a plan that plans on having less expenses. I want to fly first class, not coach. I want the best seats at the theater. I want to take that trip if I want to. And all of that goes through as a function of expenses. So my plan that I want to have, my blueprint, is to say, do I have a plan that allows for and plans for and forces my ability to answer larger expenses? I don't like the idea, like there's a lot of books that say it's called the latte factor, right? That says, well, if you have MJB instead of Starbucks, you're just not smarter. Yeah, but what if you want Starbucks? Why not instead of saying, well, I feel guilty, this is a guilty pleasure, why not create a plan that allows you for Starbucks, right? I mean, I love what Robert and Kiyosaki and Kim Kiyosaki had Betty the bookkeeper. And they would look at these numbers monthly. I look at them weekly with Laurie the bookkeeper, is our bookkeeper. But Betty the bookkeeper, they had a rule. If they wanted something, they were not allowed to say, I can't afford it. That was a rule, in their life. And they would say, how can I afford it? And that's right out of Rich Dad Poor Dad, by the way. You can read that out of Rich Dad Poor Dad. So the expense number is where we ask the question, how can I afford it? When we play the cash flow game, we pick the dream first, and we don't look at the price tag on the dream. We just look at the dream. And then when we see the dream, we reduce that to a price tag, and now we have a project that we can work on. So when I look at expenses, I say, what does my dream life look like 10 years from now? I'm living a pretty good one now, but I'd like it to be better 10 years from now or 5 years from now. So what's the price tag on the next level? If I don't know the price tag, it's a dream. If I know the price tag, it's a project. And now I can start to answer the question or ask the question, how can I afford it?
I love that. That's one of my favorite takeaways from Rich Dad Poor Dad is just that mindset shift of how can I afford it? All right. So we've got expenses. What's the next number? Number 2.
Well, expenses can be addressed in 3 other boxes. There's 4 boxes in the financial statement in terms of income statement, balance sheet. And so you look at that hungry monster that needs to eat food. Picture it like this: we got to eat. So the first place we could go is the refrigerator and get fresh food, new food that just came in from the grocery store yesterday. If that's empty, then we have to address expenses in the pantry, and we find the canned food that's been there for a while. If the fridge is empty and the pantry is empty, then we have to go to the liability column. We got to go to our neighbor and borrow a cup of sugar and borrow some food. So you have new money that comes in to address new bills. That's income. You have old money that can come in and address new bills. That's investment assets. And then you have borrowed money that can come in. So when you look at the cash flow pattern, how does the government solve the problem of expenses? Well, they do it with debt. They borrow the money to do it. When you look at a company that is on the rocks, that doesn't have, or someone who's lost their job, or a 401k cash flow pattern. 401k guy doesn't have new money coming in. They use the old money and they sell out their 401k. It's a race against time, both in debt or in asset. So the best way to address expenses is the fridge. Go to get the fresh food, the new money. That's called cash flow. That's why we have the Cash Flow Academy. We have the Cash Flow Game. It's about, we have the Cash Flow Quadrant, right? It's about how you produce new cash. So the second number is the income column. And we look at the income column, we begin to say, what direction do we want that to go? Well, I have, there's, from a tax standpoint, you can have passive income, you can have, investment income, dividend income, you can have what we call ordinary income. That's for, Tom Wheelwright to teach, so I'll stay away from that. But in mine, I look at it really in two categories: working for money, every money worked for me. I used to get highly paid, like dream job, really, for giving speeches. And I could demand, what I think I'm not like $100,000 speech guy. Let's not say that, but definitely five figures for sure, a good five figures for sure per day. So, I could go out and really make pretty good money above average just by giving a few speeches. Here's the problem. I had children. I don't want to leave them because now my time at home, I'm not going to miss that. So I set a goal to reduce my income, my active income. Isn't that interesting to have a goal to have expenses go higher and to have a goal to have income drop? Because if I can afford more expenses without having to work for money, that equals a better life. So I want to plan that expenses are going to get higher and accommodate that. And I want to plan where active income goes down. That means passive income goes up. So when I look at that number, I say, what do I want to do with the expense number this month? Do I want to curtail expenses or do I want to increase them? That's part of the weekly meeting. Look at the active income. Do I want to go out and work for money? No, I don't. I turn down 99% of there's like two people I can't say no to on the planet. Both of them are. But everyone else, it's a no. I like being home with my family. I don't want to work for that money. I don't mind doing active things I enjoy, but yeah, absolutely, we want passive income. So the second number is income.
All right, I love it. Passive income, love passive income. Now we go to our third number. What is the third number that we track?
Third number is cash flow, right? Income minus expenses is cash flow. There's a lot of names for it. Robert and Kim call it cash flow. This can be a little confusing if you talk to your accountant, so you need to know all the names because accountants use different names. Wall Street investors use different names. Real estate investors use different names. You have things like, net operating income and cap rates and bottom lines and net income and earnings and cash flow. All of those are representing that refrigerator, that new money. And so we really want to be able to see cash flow go up every time. That's always going north. There's never a time where we want that one to go south. Some people, it kills me. I'll show someone how to make a whole bunch of money. They'll say, well, if I'm just going to have to pay tax on all that money, call your accountant and deal with that. But, you always want your cash flow to increase. Always, 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 100% of the time. And passive cash flow for sure.
And I always like to say, your accountant is worth their weight in gold. They're phenomenal people. If you got a good one,
your team, yeah.
All right, number 4. What is it?
Assets, for sure. Income producing assets. Now, this takes education because I divide my assets up how the world sees it, so they can be happy. My accountant is going to see things like gold as an asset because I could sell it. Now, it doesn't produce income. It sits there. Things like diamonds, right? Things that I've purchased that if I wanted to liquidate, I could turn them into cash, but then I'd lose the asset. So I have non-income producing things where I define by ownership only. A house, Robert always says a house is not an asset. Well, yeah, when it comes to cash flow, he's right. If we define it by assets, put money in our pocket and liabilities, take it out, he's correct. And that's a great definition for someone who wants to be wealthy. So then we look at the asset column and we need to say, what am I going to buy this week? And that's a really important thing. I'll get to when you do that, when you make that decision, you say, what am I going to buy this week? So for example, this week I'm going to do some stock investing and I'm going to get some money from some options on this very week. I will have money come to my family because of the options market. At the beginning of the month, I'll say we're going to have money come in from rents, right? And distributions from syndications, right? And throughout, we have a nice business. So we want to have money come in every day from our business. So we're going to look at that week and say, what are the opportunities for us to enhance any of those asset classes? Most weeks I don't buy a new property, right? Most weeks I don't. Almost every month you can acquire more stock. If you know how to cash flow stock, you can reinvest that, and the shares can be so small that you can always be buying a few more shares. So by measuring that, you're going to ask the question, did we buy an asset last week? Yes or no? Are we going to buy an asset this week? Yes. What is that asset going to be? When are we going to buy it? What is it going to look like? And if the answer is, I don't know how to buy assets, well, then you're going to buy some asset education. You're going to go out and invest in a mentor or a coach or a course or a book. But you're going to make an investment, at least in your brain, which is your greatest asset. So assets is the next number.
All right. Number 5, we've got assets. What's after assets?
I want my liabilities to go up for sure. Absolutely want my liabilities to go up for freaking sure. Particularly there, just like I said, there's in the income, there's active and passive, working for money, money work for me. In the liabilities, there's good debt and bad debt. The definition is easy. Bad debt, I would have to pay off. That number goes down. Good debt, that's that other people pay off. That one needs to go through the roof. That one needs to go as high as fast. And this is where David Ramsey and I part ways so fast. Borrow as much as you can, as fast as you can. He says never go into debt. I say no. The smartest thing you ever could have done 30 years ago is borrow as much money as you possibly could, bought some real estate that cash flowed, and watch those assets climb, get that level. This is the smartest thing you ever could have done. Smartest thing I ever could have done is got some money and then take that money from rent and then go out and buy some stocks with it and let the dividends climb with inflation, because the dollar's losing value. And you want a short position, which is a liability. You want to do, you want to borrow, exchange back, return. Those 4 steps are short position. You take short positions on stocks that go down, currencies that go down, anything that's going down, you borrow it, exchange it back, and return it at the lower price as it's gone down. That's so simple. It's 4 steps. Totally lost on Dave Ramsey. He wouldn't even understand that. Like, he would not, if he understands it, he's just being belligerent then. Because I can't promise you that a stock will go higher. I don't feel confident in that. I have to kind of guess and use strategies and exits and all that. You want a prediction? The dollar's going to be worth less 30 years from now than it is today. Absolutely. We're printing money. We're printing like crazy. We have inflation coming out of our ears. You're going to look at me a straight face and say, 30 years from now, your dollar's going to go further than it does today. That's the surest bet I can imagine. And so you would want to increase that liability column with good debt that other people pay off. It's the best in the world. I would that's why I love real estate as well as stocks. I would never, ever say, gee, I never lose a wink over the debt I have in my real estate portfolio. Never, not a wink of sleep. So I want that debt going higher for sure, as fast as I can, as much as I can accommodate. And the criteria is, does it cash flow and is there a margin of safety, right? If there's a pullback, you don't want to be swimming with your pants down. Like Warren Buffett says, when the tide goes out, you see you swimming naked. That's where the margin of safety comes in. You don't want to be too aggressive with it, but you want to push that envelope to the edge of wisdom, but not beyond the edge of wisdom.
All right. It made me chuckle there with that visual of the tide going out.
You don't want to see me with the tide out, man. I'm going to keep my swim trunks on and my coat, and I look like Bigfoot. That's why I don't go to the pool, because they get Bigfoot sightings. So I keep my coat on.
I love it. All right. Last but not least, number 6.
So most people might say, all right, well, it's going to be net worth, right? We had income minus expenses was cash flow, asset minus liabilities with net worth. That's not the number. That's not even an important number. You can track it if you want. People will ask you about it. I'll bet if you asked Robert what his net worth is, he probably wouldn't even know. He'd know his cash flow probably. But net worth is a number that is fickle because it's simply a function of people's opinion of your assets. So my net worth could change tomorrow if people change their opinion about the real estate market and the price of my real estate goes down. but they don't get to change, their opinion as quickly, a little bit with cash flow, but less quickly. And the net worth is an hourglass. It doesn't really, it's the weakest number of all we've talked about. It's the most irrelevant number. So I would say the sixth number is buying power. Buying power answers this question: how big of a game can you play right now? So if I come to you and I have an opportunity for $100, can you play? Do you have the buying power? If I come to you and I have an opportunity for $10,000, can you play? Do you have the buying power? If I come to you and I have an opportunity for $1 million, can you play? Do you have the buying power? So buying power, you might look at liquid assets, stuff you could turn to cash very quickly, and borrowing, both institutional borrowing and private equity borrowing. And then there might be another way with education, you could throw that in there, because buying power increases with intelligence, because you can take control of more assets with less money, and you can increase the amount of asset you can play with financial education, particularly in the options market. So the buying power has to do with financial education, liquidity, your own liquidity, and your ability to leverage other people's money. And that is why, the big guys like Kenny and Than and Robert and Kim, that's why, all of us, accredited investors can play a bigger game, because, when you say it takes money to make money, yeah, it does. It doesn't have to be yours. And it actually just takes education and imagination, because if you have an imagination, you can create buying power. And the way, Robert creates buying power is through debt. That's how he creates his buying power. One of the ways, you can go public, you can create cash and buying power all kinds of different ways. But that buying power number is really important, because this is why it's more important than net worth. If I come to you and I say, your net worth sucks, move that number, you'll say, well, how? We'll buy some assets. Well, I don't have the buying power. Oh, so you're saying it starts with buying power and education, knowing how to buy things and having the ability. Oh, I see. So the engine that starts the perfect cash flow is really borrow, trade for an asset, cash flow, expense return. That's the ultimate right there. That's infinite return type stuff. And so that buying power is the engine. It is the genesis. It is the place it begins. It's where it sprouts. And that number begins with education. That number begins with learning. And that's why financial education is the way to elevate the financial well-being of mankind. That's why, because it starts with their ability to acquire assets, and the ability to acquire assets comes through, intelligence, know-how, and buying power. And those are 6 important numbers.
There we go. All right, so let's put a bow on this. And my final question is this: if someone wants to start improving these 6 numbers and take control of their financial future, what's the first step they can take this week?
Oh, throw me the softball over the plate. It's always the same. Go to stockcastbonus.com for sure, especially in this episode, because those numbers, we have a whole ebook on that, and we can go into detail. One more thing I'd like to add, if I may. In that weekly meeting, you have your current financial statement, and then you have the future one that you want. So you do that exercise of dream, turn the dream into a project by putting a number on it, and then you have where you are now and where you'd like to be side by side, and you say, how am I going to bridge this? So the third part of that meeting, where you are now is the first part, where you want to be is the second part. The third part of that meeting is the calendar. So you asked how to move this needle. As you focus on this meeting, you say, okay, on the calendar, what are the activities that I'm going to put in my life that will impact one or all of those numbers in a slight way? So if you don't know anything about buying power, that's where you start. That's the engine. Okay, this week we're going to invest in education, time, energy, money, whatever, to start learning about that. Oh, we've not got buying power now. Oh, now I got to learn how to buy an asset. Well, I don't know how to go to the market and click and get paid. Oh, okay, well, drop by and Andy and go to the Mentor Club with Noah Davidson or Corey Halliday or myself will show you how to click and get paid. Oh, good. This week I'll click and get paid. Or I don't know how to buy real estate. Oh, I do know how to buy real estate. Okay, well, now I'm going to call this guy and do this system. So wherever you are in the system, you put something on the calendar that you say, okay, this is where I'm stuck, and you get unstuck with something on the calendar to get you unstuck and get you buying assets. So the calendar and the scheduling of meet with your accountant, meet with your attorney, meet with your mentor, meet with your coach, meet with your agent, meet with a buyer, meet with the seller, whatever those meetings are that facilitate those assets, that gets on the calendar.
That's huge right there. And Andy, thank you so much. This has been mind blowing. Listener, financial success isn't random, it's mathematical. And when you understand these numbers, driving your financial life, you gain power to change them. And again, big thank you to Andy Tanner for breaking this down so clearly for us. And if you want to start improving those numbers that drive your wealth, go to stockcastbonus.com right now. You'll find those 6 numbers in there. You'll find free tools and education designed to help you to invest smarter and increase your financial confidence. And if this episode gave you value in any way, make sure you like it, subscribe it, share it with someone who wants to improve their financial education. You're not here by accident. You're building something that most people won't. So stay smart, stay invested, and we'll see you next time.
This podcast is a presentation of Rich Dad Media Network.